Well, good morning, everybody, and welcome.
Good morning, everyone, and welcome to the third session of day one of the Growthpoint Investor Showcase for 2021. The current session is a business update on Capital and Regional, which will be provided by Lawrence Hutchings, the CEO, and Stuart Weatherly, the Group FD. We will follow a presentation format, which will be followed by a Q&A. Feel free to pop some questions during the presentation in the chat box, but I will run through the Q&A process afterwards, where you can also raise your hand and ask your question directly. But with that, some housekeeping issues quickly. Please remain on mute and ensure your video is off. And with that, I'll hand over to Lawrence and the team.
Fantastic. Good morning and thank you. We're dialing in today from the subtropical paradise, otherwise known as London. So I hope South African summer is treating you well. Firstly, thank you for your time. I'm joined by Stuart today, our Finance Director. We have a presentation that should take us sort of 25 to 30 minutes to get through, and then the plan is that we have Q&A at the end. So we've left sufficient time to answer any queries or questions you may have. We understand UK and UK retail is very topical at the moment, and obviously having just undertaken our refocus, restructure and recapitalisation of the business, otherwise known as Project Sunbird, we are, it makes the Growthpoint investment us very topical. So very happy to field any questions at the end. I just thought we'd step through our presentation. This is a combination really of some sort of historic material about the community centre strategy, which we definitely think is worthwhile just doubling down on for a moment. And then we've got some more contemporary material that related to the Sunbird transaction and the market-facing presentation that we did a few weeks ago. And of course, drawing on our half-year results that we presented on, I think, the 9th of September, Stuart. So it's all fairly contemporary information, but the first couple of slides really talking about the community strategy. I just want to apply a quick health warning on the community centre strategy, that for those of you in the Southern Hemisphere, for those of you in continental Europe, for those of you with American backgrounds or spent time studying the US property market, the idea of a grocery, or even Australia, where I hail from originally, the idea of a grocery-anchored shopping centre and its characteristics being fundamentally different from a regional shopping centre, which historically in nearly all the developed world has been anchored by department stores as opposed to grocery or supermarkets, is I can appreciate sort of second nature to a South African investor, to an Australian investor, to a continental European investor, to an American investor, is second nature. Even in Asia, Link REIT is one of the largest REITs in the world, run by a guy called George Hongchoi, who I know, and they invest in these community supermarket-anchored, non-discretionary shopping centres. However, in the UK, this is we don't have the same level of distinction. All shopping centres have historically been put in the same bucket, and some are called A malls or prime centres, which is typically the big all singing or dancing super regional mall or regional mall. And then there's called secondary shopping centres, which are smaller shopping centres. So we don't have the same distinction. And typically B malls or secondary shopping centres have been quite volatile. So investors have made a lot of money playing yield curves around the secondary shopping centres. But our view is that market's maturing. We're coming in line with the rest of the world. That was our view in 2017. There was a real opportunity, and our real estate lends itself to this community centre format. So our objective when we launched a strategy in December 17, which is the pillars of our strategy, actually relates back to a presentation we did in December 2017. We believe that holds true because that strategy was put in place with a good line of sight, a very good line of sight, to the structural changes that were taking place in our industry. Long cycle structural changes driven by technology and online shopping and the disruption that was causing in physical retail. So we put this together in 17. The UK is one of the most advanced markets in the world for online penetration. We have higher online penetration here than they do in the US. That has been the case for the last 14, 15 years. So it was easier for us to see the trajectory and speak to our retailers and see what they were doing and understand it. I won't for a second sit here and say we underwrote COVID or we could see COVID coming. There is no way we could do that. Everyone would have acted differently. But what we can say is that COVID, from the position that we sit in today, has really served to accelerate in the retail sector pre-existing trends and now this pre-existing long cycle structural change. And if you read a lot of the commentary coming out of the largest retailers in the UK, they're talking about seeing 5 years acceleration in about 18 months of this structural trend, so principally online. So we think we've had probably the worst and the best type of crash test of our strategy in the last 18 months. I'm not going to sit here and say we've come out of it well or we'd vote for it again. There's no way we would. We've been through an incredible humanitarian crisis, but we've learned enormous about our business, about our industry, about our sector, and importantly about our strategy. And in fact, we spent a day yesterday, Stuart, with our senior leadership team in an offsite, just sitting down and reviewing exactly what we've learned over the last 18 months and how we need to tweak this strategy or change it effectively moving forward. But the consensus view amongst the senior leadership team was the strategy is the right one, effectively. So if we talk about a little more detail, what did we set out to do in December 17? We said we need to define the community shopping centre because it was so ill-defined in this market. As I say, everyone referred to them as secondary malls. Our view is they're far from secondary. We had 30% of our stores open during the pandemic. If you compare that to super regional malls, many of them had to close because none of their stores were allowed to open. So if we talk about being essential and non-discretionary retail, 30-odd% of our stores were able to open. All of our centres traded throughout the lockdown periods in the UK. So our task was how do we better define the characteristics of these community shopping centres in the investment market fundamentally, because retailers understood it. We did a lot of work with a big research house here, which is part of Accenture, called Javelin, who consult on a very regular basis to some of the largest retailers in the UK. And what Javelin told us was that the profitability of our stores in our locations, was not dramatically different to the profitability from the big regional malls. Some of that was driven by lower occupancy costs. And what we also realised was that the trading densities were a lot more similar than the rents were between the super regional malls and our locations. So we established retailer profitability, but our challenge in 17 was we needed to re-merchandise further into the community model. So put more grocery into our shopping centres, reduce the amount of fashion. And I'm pleased to say we've been doing that. I will say the last 18 months to 2 years has created some disruption in that process because we've put the brakes on our CapEx program, and typically our CapEx is about re-merchandising, turning department stores into supermarkets and gymnasiums. That's typically the sorts of things we do with our capital, rather than refurbishing our shopping centres or paying a fortune to put leisure in. We're really about re-merchandising. We're not adding floor space per se. So step one was define or redefine the community shopping centre in the UK market. I think we've made huge progress in that area. The valuers now sit down with us, external appraisers, as I believe you call them in South Africa. They sit down with us now and say, your centres are different, or they'll use the word community shopping centre. So in 4 years, we've managed to achieve some definition around what we do, and that's growing. Certainly COVID in some respects helped because so many of our stores were open. We need to position, or in this case, reposition our assets and our retail mix. I touched on that a moment ago. So the mission here was we were carrying almost 40% of fashion. We were carrying department stores. We needed to re-merchandise out of those categories and put more grocery and essential retail in, upsize our pharmacy offers, for example, increase our personal and professional services exposure. And then the third thing was to focus our management team. So we realised we needed to be more agile, we needed to be more data-driven, and in order to make faster decisions and be more agile, we needed to decentralise. So in the shopping centre industry, you run two business models effectively. One is that you centrally manage like Simon or Westfield, so every single decision is taken centrally. The other one is you decentralise and you push effectively decision-making down into the closer to the assets and closer to the ground. And we said for a community shopping centre to be successful, it needs to be highly tailored into its local area. Why? Because our demographics in Blackburn are completely different to Ilford or Walthamstow. So the definition of success is not looking the same. It's actually tweaking these merchandise mixes so that they relate better to their unique demographics. And the best people to make those decisions were the people on the ground or closest to the ground. So we've made huge progress in that area. And finally, we believed if we did all of that, we could enhance shareholder value over the medium to long term. Now, that's a difficult statement to make given what we've been through. We've sort of lost 70, almost 80% of our value, Stuart, during COVID. Clearly with lockdowns and the other impacts, but we, on a relative basis to our immediate peers, Hammerson, of course, when Intu was still around, we were tracking our performance against Intu. We still see the performance from some of the Intu assets in terms of rent collection, in terms of occupancy, in terms of leasing spreads. We have outperformed our peers, but on an absolute basis, clearly our sector's been one of the sectors most impacted by COVID. So that's a little bit of a recap on the strategy. As I just touched on, we're moving slides now onto the next slide. And I said that I've made a statement here that, or we've made a statement that we've delivered robust operational performance. As I touched on a moment ago, our performance on a relative basis to the other retail categories has been very strong. And we believe that's in no small part due to two things. One, the types of centres, these community centres where a large percentage of stores have been open and trading, the increased recognition of the role of these community centres as a consequence in providing, effectively, when I was at Blackstone, John Gray used to say, Lawrence, these centres are part of community infrastructure. And Blackstone had a strategy to invest in these types of centres globally. In many cases, over and above a regional mall type investment. So, as I mentioned, structurally change, we're aware of the structural change. We've been proactively repositioning. We did an enormous amount of work from December 17 through until March 20, when effectively the world changed overnight, or pretty well overnight. We've got more to do, there's no question, we'll come to that in a moment. Management is the other reason that we believe we've outperformed. We've made an enormous amount of change here in this business over the last 4 years. I think probably 55% of the headcount has changed. We've introduced systems, we've invested in back office, we've changed the shape of the organisation. So we've got more people involved in income generation than we've ever had. And we've slimmed down the support office and back office functions by investing in processes and, importantly, systems to make us more efficient. And then finally, we're community-centric. We place our teams and our communities at the centre of absolutely everything we do. So whenever we make a decision about a leasing decision or investment decision or changing something, the question is always, what does this do for our local communities? So we turn to the next slide. And basically what this slide demonstrates is the progress that we've made from 2017 to 2021 in re-merchandising these centres into these non-discretionary and community uses effectively. And we're proud of the progress we've made. There's more to do, there's no question. And we've got a runway of those projects that we'll touch on later that will further re-merchandise and diversify our income, increase our exposure to these key categories. But we have made a lot of progress. And this is impressive in that the last 18 months, whilst we've been doing a lot of leasing, the big projects effectively have been on hold. So one of the benefits of this recapitalisation event and restructure that we've just been through and refocus is that it will allow us to double down on re-merchandising these centres. And the advantage for us in re-merchandising is because we're coming off low rents of 12 to 15 pounds a foot, we can do a deal with little at 12 quid into a former department store that was paying us 5 or 6 quid a square foot. So we can do this accretively from an income standpoint, which is an enormous difference when you're dealing with a regional shopping centre where rents are 60, 70, 80 pounds a foot. To put our 12 pounds a square foot in rent in perspective, I'm often reminded when I get on a train and go to our shopping centre in Ilford, we stop at Stratford on the way there, and Stratford's service charge, the Westfield Centre, their service charge alone is £25 per square foot. So when I mentioned earlier about retailer profitability, this is one of the reasons why we've made such good traction on leasing is through the whole COVID experience, retailers have realised the importance of these local venues. It's reminded them the importance of these local venues. Secondly, the profitability of these local venues. So occupancy costs with us are typically 12 to 15%. With the big regional malls, they're north of 20, 25%. So interesting, there's still a hesitancy here in this market around large indoor crowded places. So the local centres are still seeing a benefit, the community centres are still seeing a benefit from people wanting to shop locally. So effectively, I'm going to just change gears now, and I thought we'd talk about the recapitalisation and restructure, refocus, the 3 Rs as we call it, that we launched a couple of weeks ago. We know it's topical. We're very grateful for Growthpoint's support throughout this. Norbert and George Monchaya have been excellent, and SDR, and obviously sat on our board throughout the entire COVID experience. But I might just run through this first page very quickly and then hand over to Stuart to walk us through the detail. But broadly, the headlines were that we undertook a fully underwritten £30 million open offer to part fund a $100 million purchase of outstanding debt from NatWest for £81 million. So representing a discount of £19 million or 19% to the par value of that loan. So the acquisition of debt was key because that provided £19 million towards the recapitalisation of the group. And that in turn reduced the burden on our shareholders in terms of recapitalisation, because effectively the purchase of the debt had funded a large part of the recapitalisation project. And Stuart and I had been working on it for probably 9 months, Stuart, on that deal to effectively buy that debt from NatWest. Now, we realised early in the piece that we didn't have the £80 million, so we had to join with our co-lender in that facility, which was Nuveen, and convince them to put another £30 million. They were £165 million. Convince them to go effectively to £200 million and join us in buying the NatWest debt. But importantly, they gave us the benefit of all of the discount. So our effective purchase price for that debt was in the low 70s, Stuart, about 72p. So the way I like to look at the transaction refocused the business, which was really about saying the two assets that were underwater, which was Hemel and Luton, which represented about £130 million in debt, because they're non-recourse facilities, so non-recourse to the group, that we would effectively ring-fence those facilities as we're able to do and stand back from those. That brought our debt from 427 to 300 million. The next step was to buy the NatWest debt effectively. So that took another 19 million out of our debt. And then thirdly was to raise another 30 million pounds in equity, which as we now know, we got 72, 73% take up on that underwritten by Growthpoint, which moved them from 52% to circa 60% as a shareholder. But the combination of those three events brought leverage from about 72% down to 49%. And importantly, we have a line of sight to further reduce leverage through three key initiatives. Number one is that we're very close now to realising £20 million as a capital receipt back out of the sale of the residential at Walthamstow. So that's worth about 200 basis points, Stuart, off leverage. The second thing is we've agreed heads to sell an office building in one of our assets, and that will realise circa £7 million, which should have circa 100 basis points impact on leverage. And the third thing is we've signalled to the market that our intention is to resume dividends the second half of next year. Clearly, we hold cash in the interim, and holding that cash will further reduce leverage, affecting the cash that's generated from the assets, keeping in mind that the mall fund, we've now got access to that cash as part of this debt restructure, which Stuart will go into in a moment. So importantly, we can see a position without any uplift in value of the real estate, so without any increase in value in our portfolio, we can see a situation where leverage lands in the sort of mid-40s. So with that, I'm going to hand over to Stuart to take you through in more detail. Thank you.
Yeah, thank you, Lawrence, and good morning, everybody. Maybe if we can turn to the next slide, I'll just give a bit of context on valuations, because I think this is an important point. But first, Lawrence mentioned the split we've made between our assets, between what we've termed investment assets, which is the core MAL portfolio, the one we've restructured, and our Ilford asset in London, and then our managed assets, Luton and Hemel, and I'll touch on those on the next slide. But in terms of valuations, what we've seen is a real stabilisation, which has been hugely encouraging. We've certainly suffered a lot of reduction in value. If you go back over the last 18 months, 2020 was clearly a painful year, with COVID exacerbating some of the structural changes that were already happening within retail. We started to see in the first half of the year a slowing down in that rate of decline. And then, due to doing the equity raise, we also needed to commission valuations at the 30th of September for the purposes of the prospectus. And I think very encouraging to see in that 3-month period that we've seen values on the investment assets not only stabilise, but in 1 or 2 instances tick up slightly. And I think we are seeing in the discussions we had with valuers and other people in the market, certainly more confidence returning to the market, and a view that any further changes in shopping centres of our nature, I think important to say that's not for all shopping centres, I think there's a view of shopping centres of our nature, that any further valuation changes will be driven by income. And I think one thing that was particularly encouraging, the £1 million uplift we saw in Ilford, was really driven by the letting we made from the former Debenham space to create a job centre underpinned by one of the government departments. And so we've seen really the impact on the progress we've made on leasing, and Lawrence will talk a bit more about that later on, starting to see that come back into solidifying valuations and hopefully in time some potential for those to bounce back. So I think that is a very encouraging sign for us to have seen that stabilisation over that short period, having suffered this significant decline previously. Perhaps if we can roll on to the next slide, just talk about the debt position by facility. And again, split between our managed assets and our investment assets. So the key change with the transaction has been on the mall. Lawrence has talked you through the headline statistics, but in terms of debt, what it's done is really reduce external debt from 265 million to 200 million. It's consolidated it all with one lender, so TIAA or Nuveen as they trade under, and really rebased that facility, bringing the LTV back on a net basis to under 60%. And as Lawrence said, 2 initiatives that both sit within that portfolio that will have a significant impact on further reducing debt, not only within the MAL, but obviously for us as a group overall. On Ilford, we've got a number of CapEx initiatives, which we'll touch on later, and working closely with the lender to get relaxation and to work through the facility as we essentially rebase that asset, and a lot of very exciting opportunities there, which we'll touch on in a minute. I think it's important just spend a couple of moments on the managed assets. So Luton and Hemel Hempstead, and worth noting there is a differentiation between the two of these. Hemel Hempstead is, sorry, the asset is, as you'll see, significantly underwater. There is a new lender has bought that. It's been part of an asset set, part of a portfolio sale by NatWest. We are engaging with the new lender, but I think we may well see that there is no economic benefit to us remaining in that asset. But if that is the case, we'll do that in a very orderly process. Luton we see quite differently. We think it's been a very robust asset in terms of cash flow performance, so it's continued to meet its debt, spin off cash to be able to invest in CapEx. And touching on the points on valuation on the previous slide, we don't think you have to believe too much in terms of proving out income at current levels, building back a bit of it, perhaps seeing a bit of yield shift to get to a point where you return to having some net equity in Luton. That's not to say we're expecting it to go back into a compliant loan position, We're certainly in no rush to exit that asset. We think there could be some equity upside, but we will also, given that all our facilities are non-recourse, there's no cross defaults, if ultimately that doesn't prove to be the case, then our liability from a group perspective is essentially capped at nil. But we're getting good asset management fees off Luton. We're working very closely with the lender, and we do see that there is potential value that we can create and return from that asset. I think if we go on to the next slide, this just summarises the points that Lawrence was talking through in terms of how the different parts of the transaction impact on LTV. So if you took our group LTV pre-transaction based on the September valuations, it would have been 73%. When we essentially take out the managed assets, that reduces to 62%. And then the combination of buying that NatWest or RBS, so those terms are interchangeable, that debt at a discount, and obviously raising the new equity takes us to below 50%. And again, as Lawrence said, there's 3 initiatives that we have to hopefully further improve that position over the short term. And then finally, just on the cash position that this leaves us. So again, cash bridge here, we take the cash balance we had on balance sheet at the half year. We exclude the managed assets, given that cash is essentially trapped in those facilities. We've utilised cash to essentially buy out the NatWest debt, less the new loan we've got from Nuveen. And then there's the net proceeds, the equity raise, and they still leave us what is a healthy balance of 47 million. We think it is important, particularly at the moment. We're very optimistic about the improving operating environment, but we do still remain cautious that we may not have seen completely the end of COVID disruption. So I think important to keep some cash flexibility from that perspective. And then also there are a number of accretive CapEx projects that will be key to further repositioning our core assets. And we've listed out a number of them there. And the cash we're holding will enable us to fund those, and also gives us some flexibility for the next 12 months. Lawrence,
fantastic. So I thought I'd just take the next couple of slides. I might move through these reasonably quickly. I'm conscious of time, and I want to allow enough time for Q&A. This next group of slides provides more detail on the operational performance of the business beneath the headlines that I provided in the opening couple of slides. But as I mentioned earlier in the start of the presentation, some of these statistics you may have seen before for those who follow us from either investor presentation relating to the equity raise a couple of weeks ago, or alternatively on the 9th of September, our half-year numbers. But we'll run through them very quickly, as I mentioned. I'm happy during Q&A to come back and revisit any of these. But headline numbers, 90.2%, sorry, in occupancy. So we call that resilient with everything that we've been through, as you would appreciate. That's the end of 2 lockdowns. Interestingly, from a leasing perspective, we are on track this year to have a very strong year, fundamentally, as strong as 2019. Which was a very strong year in the business from a leasing perspective. The nature of that leasing has changed a little, what we call polarized. So big deals like supermarket deals and TK Maxx's and these types of things. At the other end of the spectrum, a lot of smaller stores and kiosks, but we'll talk about that in more detail later. So 90.2%, it's increased slightly from marginally from the half year, from the September number, and sorry, from the half year results, 30 June number that we presented in September. And we've got about another 1%, which is in solicitors' hands. So we are rebuilding occupancy. We were 97% before COVID hit, just to give you some perspective. 88% rent collection year to date, which is very strong compared to our peer group. We're not fudging those numbers. We know some of our peers are reverting to what they call a billable number, effectively. Our view is we need to be clean about these things and transparent. That is 88% of everything we're contractually entitled to bill. So we're not playing with the numerator or the denominator. 32.4 million in footfall, which is plus 5.4% the national index. 110 leases signed on average at premium to ERV and passing rents, and combined annualised rent of the 110 transactions about £3.5 million. So fundamentally, we are seeing a rebound in the operational performance of the business from both a footfall standpoint, from a leasing and income generation standpoint. And as Stuart mentioned, I think I mentioned earlier, we are seeing a sort of flattening in the rate of decline on valuations. More on that in a moment. Moving to the next slide, footfall and occupancy recovery. The graph on the left actually belongs to a company called CACI, and CACI are a highly regarded, well-used research house in the UK. Very briefly, the yellow line is all UK venues, and we're tracking from effectively the release of lockdown measures and looking at recovery. So all UK venues include seaside resorts, high streets, etc. So clearly some of the entertainment-based towns and seaside areas did very well coming out of lockdown because people were unable to travel. So people rediscovered those sorts of locations that had probably been under a lot of pressure from a footfall standpoint for many, many years, because you could go to Spain for 20 quid from here and spend 2 weeks in the guaranteed sunshine. So when that was taken away from people, they rediscovered these sorts of venues in the UK. The blue line, the teal blue line in the middle, is actually the local malls. So once again, the community type shopping centres, and you can see their performance and their rebound back towards effectively pre-lockdown levels. And then finally, you can see in the navy blue is the big regional shopping centres. And we're hearing feedback that they're at sort of 60% of 19 levels from a footfall, 60 and 70% of 19 levels. Same as the city centres, West End, for example, Birmingham, etc. Then the slide on the right looks at our occupancy in more detail, and this is referring directly to our occupancy, as I mentioned, 90.2%, and you can see the prior year comparisons, and you can see the progression. And the point we make here is we think it's been very stable with the force 9 gale that we've been in the retail sector, and we think that relates directly to the types of occupiers that we have. We heard the other day one of the big flagship malls in London, one of the big super regional malls, has over 100 vacant shops in it. So on a relative basis, we think we've done reasonably well. We've certainly got a lot of momentum in rebuilding from this point, from a leasing and operational perspective. Next slide, key performance indicators, sorry. So this slide changes gear a little bit. Stuart mentioned valuations. In my position, you need to be very careful calling the top and bottom of the market, as you'd appreciate. But I think these 4 slides are insightful. So, or 4 graphs, I should say. So one is our portfolio value tracking back from 17. So there's a need to be humble here. We've lost an enormous amount of value, and shareholders have lost a lot of money. So we are very humble about this. But you can see a flattening between June and September. And the indications are, although we're just starting to sit down with values the next couple of weeks about December, that the expectation is that we should be flat-ish. It'll be income-driven, really, changes in income, rather than dramatic, changes in the capitalisation rate. The next one that we look at is directly below that, leasing spreads. We think this is a really important measure. So how are we leasing compared to the estimated rental value that the valuers ascribe to our shopping centres? So this speaks to the V line. Now, I will point out that in some cases, the ERV can be lower than the passing rent, can also be lower than our own estimate of rental value, but this is what the valuation fraternity used here, quite rigid. So we've been outperforming the valuers' expectations of rents effectively and pretty consistently over the period. Then on the next slide, top right, you'll see effectively the number of shopping centre transactions. So we are seeing, importantly, speaking to this capitalisation rate and liquidity in the shopping centre investment market, we are seeing a rebound in activity. So that would also speak to a stabilisation in income and values. Of course, one of the challenges of the last 2 years has been how do you underwrite income? But the fact that there are investment transactions happening, speaking to investment agents, They're saying they're seeing 3 and 4 bids on assets. The liquidity story is a little patchy. So typically smaller assets. Most of the transactions have been under £30 million, but there is definitely activity. There was a larger transaction, Solihull, sold by the former Lend-Lease Retail Trust at 90 million to American private equity. That was done in the last couple of months. The sale of Blue Waters in the market, a 20-odd% stake. There's rumours that Land Securities might double down on that in the 7s. So the fact we've got transactions in itself starts to create some type of floor on values. And the final one is leasing transactions, values and volumes. And I'm always fond of pointing this out, but for a long period of time now, we've been pretty consistent in the number of leasing volumes, the amount of leasing volume we're doing and the values of those leasing transactions, as you can see on this graph. So if solidity around the income lines is important to value, to get certainty around value, and if that's important in unlocking transactions, so the capital markets, retail capital markets, it does feel as though our timing on this refocus, restructure and recapitalisation, and it will be a hindsight test to a degree, looks as though it's been reasonably sound. If we move on now, merchandise mix matters is the next slide very, very swiftly. I'm not going to dwell on this. I think we've touched on most of these points. Who are our top retailers? Superdrug, pharmacy, Boots, pharmacy, they're in our top 10. Primark and TK Maxx, I mentioned apparel. We believe, a bit like the US power centers, that there is absolutely a market for us to be in the fashion basics or basic apparel market. So Primark have one of their top 10 stores with us in Wood Green, for example. TK Maxx, everyone loves a bargain. It's value, volume. The sporting goods retailers we do very well with. Wilko's basically homewares. H&M is a very similar story. We've got some council income, JD. So that's really the composition of our top 10. If you went back 4 years ago, Debenhams would be number 1. The department store group would have been number 1. So the next slide. I've got 71% of our centres are grocery anchored naturally. Just some very quick leasing insights, delving into a bit more detail. I mentioned polarisation in demand, large format and smaller. Who's leasing space in the smaller stores? A lot of personal services, hair, skin, nails, as you can see here. Who's leasing space in the kiosks and some of the other small units? Grab and go food. And we think that's a shift with more people working from home, that we are seeing more demand for grab-and-go food solutions within the centre. Typically, people will work from their home office. At lunchtime, they'll come out. We're in these 15-minute neighbourhoods, principally. They'll walk to the centre or town centre. They'll get something to eat, and they'll go back again and get ready for the afternoon shift on Teams or Skype or whatever. We're growing the next generation of retailers, importantly. We have seen a real shift in the nature of our demand. A lot of entrepreneurs and startup businesses. We're well positioned for that. We have lower barriers of entry. We're able to support them in. We've seen a lot of our leasing activity in that area. And then all of this is encouraging us to think and work very differently, disintermediate the relationship between landlord and tenant or retailer and owner manager in our case. Then just changing slides on to the next one very quickly. Residential is an important part of what we do. I'll talk about Walthamstow in a moment. We announced the last couple of months that we struck a strategic accord with a very large residential developer called the Far East Corporation, listed in Hong Kong. We've been in discussion with them for about 3.5, 4 years. They like our real estate. They see real angles for residential development. The guys have got a very, very big business in Australia, headed by a former Lend-Lease executive. They've developed thousands of apartments in that market through many different buildings across Victoria, New South Wales and Queensland. They took 10% of the headstock of the listed casino operator in Australia and used that to unlock residential opportunities on top of the casino in Sydney, next to the casino in the Gold Coast, and then formed a joint venture to develop the new casino in Brisbane with a residential component attached to it. So they're used to working with public companies, used to working in joint venture, used to working in complex urban situations. They've got a decent portfolio here. They've got hotels and residential. So the idea of this is, can they help us unlock residential opportunities in our estate? And secondly, can we help unlock retail opportunities in theirs, community retail opportunities in theirs? And thirdly, can we work together to go and unlock new opportunities for both of us? And we think the answer to all of that is yes. And then continuing residential, Walthamstow, which has been, one of these overnight successes, as we're fond of calling them. But we've been working on this for 4.5 years, and this was part of the rationale for the Far East turn-up. Far East agreement, I should say. We've done very well here. A lot of people talk about residential conversions of retail and adding residential. It's a far more complex business than anyone will give it credit for, especially working in London with all the various consent authorities you require, statutory and non-statutory. So we've secured our planning consent. It's the second planning consent we've had here. It's developed to rent planning consent. The first one was developed to sell. 538 residential apartments, a 47,000 square foot extension to the centre. Do we need more retail space? We have another supermarket operator who wants to come in there. So the answer to that, we believe, is yes. A new entrance to the existing underground station, which will come straight through our shopping centre and provide footfall, which is great. But importantly, we have agreed terms with Long Harbour, who is an established PRS, private rental or build-to-rent operator, investor in the UK, funded by one of the very big Canadian pension funds. And we've agreed that, subject to planning, which we now have in Section 106, which is planning gain, effectively, and a new development agreement, which we've just had secured, that we are now in the final stages of putting all those agreements to them, and they are in a 21-day window, effectively, to confirm that all of that is acceptable, and then we're expecting a capital receipt early in the new year in the vicinity of £20 million. But what we've learned is it's cost us £5.5 million over the last 6 years to get to where we are. Far East, we're very keen that we work with them. They're highly specialised. They know residential development backwards and hotel development, and they're going to help fund the workout costs of these projects going forward. And then very, very quickly, slightly unusually for the group, but we like having them on board. We've got a company that runs 2 ski slopes historically. We've been opportunistic here. We've taken on a third in Madrid, and then we're now looking at a fourth. And expansion for this group is on a capital light, i.e. capital zero basis. We put no money in, and risk-free. So we've got agreements with the landlords that own these facilities that we're paying a dramatically rebased rent or something relating to the turnover and performance of these businesses. But so that's basically the presentation. I'm happy to turn over to Q&A. Very high-level summary from me, and before we turn to Q&A, would be COVID's accelerated the long-term structural changes in physical retailing. We think the UK is at the sort of forefront or vanguard of the world in terms of those changes. We believe our community centres strategy is held up well on a relative basis, and that we have proven that we're an essential part of community infrastructure. There is, however, a lot more to do in terms of remerchandising. We believe the increased specialisation and operational intensity required to run retail assets benefits our internalised management platform. We've got a proactive approach, so our actions that are within our hands towards refocusing, restructuring, recapitalising the company, which we've done, we believe put us in a very strong position, bring the capital structure of the business back to more appropriate levels, and give us a roadmap, effectively, to take leverage down further. We're comfortable with leverage at these levels, given we've taken circa 50 to 60% write down in asset values through this cycle, which is unprecedented. And then this restructure alleviates our cash trap, which will give us a roadmap back to a dividend, which we believe is critically important. And it preserves the strength of our operating platform to take advantage of the market recovery opportunities. So with that, I'd like to hand over to Q&A. Thank you.
Perfect. Thank you so much for the update, Lawrence and Stuart. Maybe just to remind the participants that if you'd like to ask a question, you're welcome to use the chat box function on MS Teams. Raise your hand to ask it directly, or you can send me an email. Maybe just to kick off, we've got a question from Yusuf. Has the tenant eviction moratorium discouraged tenants from paying, or are the non-payers generally trading poorly? Can we expect a strong bounce back post the expiry of the moratorium, or does it require re-tenanting?
Yeah, that's a really interesting question. Our rent recovery has been improving. There's absolutely no question. We're saying today we've got line of sight for 90% year to date, effectively. That 90% threshold is very important to us, psychologically and operationally, clearly. We used to collect circa 97, 98% of rent and then haggle for the balance. I think the moratorium is definitely providing some cover for some people. And I think there's a small percentage in there of people who are genuinely struggling, if that makes sense. And when we say struggling, footfall's back at sort of 80, 82, 83% levels. Retail of 19, retailers are telling us that retail performance is, in terms of sales, is 95, 90, 100%. Some of them are doing better than 19. So what that says to us is that average transaction value is higher. People are going less frequently, spending more and visiting more stores. And the research from CSCI and others suggests that's the case. So in most cases, we don't see it as a retailer performance issue. We've still got a couple of retailers who are taking advantage of the moratorium. I think it will definitely burn off in March. That's all the feedback from government. It will burn off because it's part of a COVID package of legislation which expires in March. The government are looking at an arbitration system to resolve historic arrears. That arbitration system works in Australia. It's been running for about 20 years. It's a sort of small business arbitration unit, effectively, which allows faster remedy and more cost-effective remedy than going through the court system. But I think the answer to that is we certainly think that burning off the COVID restrictions will help, Stuart. That's our feeling.
Yeah, no, I think that's certainly true. There are still some measures we can utilise and have been, and those have been effective in delivering the result we have. But undoubtedly, once it does finally roll off, it will be helpful to us.
It was interesting last year, actually, sorry, this year, it was about, when was it, Stuart? It was sort of the summer, wasn't it? Late summer. A lot of the bulk of our arrears, when we were reporting sort of 6 and 9 months ago that we had collections in the 60s and 70% mark, the vast majority of the shortfall in payment was from our largest retailers. And there was, I'm not sure what drove this completely. We've got some theories as to what was driving it. But there was a rush from retailers looking to settle the outstanding arrears on a basis that we broadly call burden sharing, which is if you're closed for, 14 weeks, you pay half of the closure period, we'll pay the other half, and we just want to settle this and get it behind us and go back to paying rent.
They pay everything else and full service charge. And as Lauren said, I think we've been kind of encouraged but actually most retailers are keen to reach an agreement, draw a line under things and move on. And that's reflected in where we've managed to get to.
We've got a question from Ridwan at Nedbank. When do you think Cap and Ridge can return to paying a dividend?
Sure. So we've guided towards resuming in the second half of next year. So that would be, obviously that decision is subject to the board and subject to developments, but that's where we're very mindful that, having gone out to raise money very recently, it's sort of anomalous to then immediately hand it back. And as Lauren says, suspending the dividend for a further year will help reduce our leverage further. But we've given that guidance the second half of next year, which would effectively be when we come to do our interims, which is Growthpoint's year end, around August, September, we would announce, if that follows, that would be when we would announce resuming dividend then.
And just with regards to the REIT requirements, given that you haven't paid a dividend, it seems like you're going to pay the tax for the missed dividends. Is there a potential risk of losing, REIT status, and is there a cooling off period to return? What is the regulations regarding that?
I don't think so. I think HMRC, we've got a very good relationship with HMRC, and they've been constructive in the discussions we've had with them. So they've confirmed that if we settle the tax, then they certainly wouldn't look to evict us from the REIT regime. And I think there's an option to continue doing that for a period if we want, but we're very mindful we want to be a fully functioning REIT, and that is what's driven a key deliverable for us in the restructure and the recapitalisation that we've announced was to enable us to do that.
And just, for my personal benefit, I assume the answer is correct, but the rationale for the pre-COVID occupancy to drop from 97 to 90, was that on the back of primarily the Debenhams closures?
Yeah, there was some of that was Debenhams. So some was CVAs. As you appreciate, if you're a retailer and your balance sheet was stretched before COVID, like Topshop, for example, or Debenhams were already in a tough space. Debenhams had already done effectively a CVA. Topshop had already done a CVA. They just didn't have the capacity to absorb COVID. So in some cases, you had retailer failure at the large end of the spectrum, but also at the smaller end of the spectrum. We had situations where retailers had break clauses and they just exercised them because no one knew when the pandemic started how long it would be for, effectively how long the stores would be locked down for. So the safest thing to do to protect their businesses was just issue notice and close stores. And we had other retailers, smaller retailers, large retailers that failed, and we had sort of hangovers from CVAs and administration. So it was a combination of factors, wasn't it, Stuart, effectively, that drove it?
Yeah, it's probably 2 to 3%. It's Debenhams and the rest of the factors Lawrence has outlined.
Yeah. And as far as the trends with regards to increasing risk from CVAs, notices being provided for break clauses over the next 12 months, is that an increasing trend or decreasing trend?
No, I think they're separate. So we're not seeing the number of notices. Retailers are wanting to retain their store network now, or potentially we're looking at our leasing numbers. In some cases, grow it, or importantly, right-size it. So I think retailers have also learned a lot over the last 18 months. So Superdrug, for example, the pharmacy group, are wanting to increase the size of their stores in 2 or 3 of our centres and relocate from the high street in one location into our shopping centre. So you're seeing a sort of right locationing and right sizing, and retailers probably doubled down on that coming out of COVID, if I'm frank with you. I think they've learned a lot about their businesses. I think the CVAs is an interesting one. I was on the phone to a restructuring advisor the other day who basically runs CVAs and restructuring processes for retailers. And he said their workbook was reasonably empty. There's some rumours of a couple floating around. I think the moratorium has reduced it dramatically because before the moratorium was extended a few months ago, the feedback was that retailers were getting ready to run some CVAs, principally to write off rent arrears during the COVID period, and then secondly, to look at some form of portfolio right-sizing and rebasing of rents on stores they want to keep. So I think that's removed one of the drivers, effectively, the moratorium. And of course, the more rent we settle, the less incentive they have to run these CVAs. To give you some idea, an off-the-shelf CVA is about £1 million for a retailer to run. So they're expensive processes. You need to make sure you're getting value, firstly. Secondly, you need to make sure you're not going to end up like Cafe Nero, where effectively you're putting the business in the market and someone comes along and tries to take it off you on the cheap. So, which is exactly what's happened with Nero. There have been a couple of challenges as well. So the New Look challenge failed, but what's clear to retailers is the landlords will work together to challenge CVAs. And then there was this new process called a Section 26A cram down restructuring, which hadn't been run before, Virgin Active, actually a great company. New Look, a great company. There's a theme here. They ran this new process. It was challenged legally. The challenge failed, but the judge made it very clear in that case that there was a real need to revisit parts of that legislation that had never been tested before. So we've not seen a new CVA or a new Section 26 cramdown since both those were run about 3-4 months ago, and both of them were challenged. But I can say to you, there is an increased determination. I sit on the British Property Federation's retail board. Myself and another guy founded that, or co-founded it, about 9 months ago when the REVO, the industry body, collapsed. There is, all the major landlords dial into that. There is an increased determination to challenge all of these CVAs and restructuring proposals from the landlords.
Yeah, I think the only thing I'd add as well is when you look at our top 10 tenants, and it was on one of the slides we talked through, we feel reasonably comfortable about looking through those, that there aren't big CVA admin risks in the same way that, if we were 2-3 years ago sat here with Debenhams and New Look and others there. So, we're certainly not immune from it, but we feel that the diversification of our income and those of our larger tenants feels that it should be robust.
And it's interesting, this arbitration unit that the government is setting up for COVID-related arrears, I think will live beyond COVID. So I think the plan is that instead of small disputes between landlords and their tenants or customers, instead of that tying up the courts, that will be handled by this arbitration unit. And one of the proposals on the table at the moment from Treasury, who are running this with MHCLG, which is a local government, Ministry for Local Government, is that retailers will not be able to use one of the restructuring mechanisms if they're in that arbitration process.
Thanks. Maybe just the last question, it's coming from Paolo. The new debt facility attracts a high rate, excuse me, I'm not familiar with this, but SONIA plus 6%. Do you anticipate this facility to be repaid by the middle of next calendar year, given resi payment and retaining earnings?
I think there's certainly, as Paolo rightly says, a motivation for us to reduce that as soon as possible. We've, as Lawrence flagged, we've got the Walthamstow residential receipt, which we hope to realise in Q1, and that will substantially reduce it, and then the other disposal we talked about as well. So I think we're certainly, I wouldn't put an exact timescale on it, but there's definitely a motivation for us to reduce that debt significantly in the short term, and ideally if we can remove it entirely.
Brilliant. That's all the questions from my side, and maybe some concluding remarks from your side, Stuart, before we end the meeting. Yeah, sure. Or Lawrence, do you want to?
I think from our side, we're feeling cautiously optimistic about life. It's been a tough 18 months, but I think the transaction we've done, the recapitalisation, refocusing and restructuring, we're very grateful for the support of Growthpoint, as Lawrence says, particularly with George and Norbert, have been huge towers of strength for us as a business. And we think there's a lot of reasons. There's still a lot of work to do. There's a lot of work on re-merchandising and not a benign operating environment, but certainly with the stabilisation in property values, the positive momentum operationally, we feel we're in a good place and well positioned to take opportunities in the market moving forward.
I think that's been evidenced. The performance of the new shares are admitted on Friday. I haven't checked this morning's share price performance, but we're certainly comfortable with the range they were in yesterday afternoon. What we were trying to avoid was a situation where we had something worth 50, we put 30 in, and effectively it traded below that market cap. So the market seems to have responded positively. we appreciate all the support from existing shareholders and the support potentially. We've had some new buyers on, support from potential new buyers in the company looking to take up shares. I think we're in a probably the best position we've been in for the last 3.5 years. If you keep in mind, we launched strategy in December 17. I think that was now widely accepted in hindsight as the peak of the market. So for the last almost 4 years, we've seen declining asset values. To see this stabilisation in asset values, to be undertaking this recapitalisation at this point, and to be looking at a position where we could potentially participate. I'm not in a hurry to run out and buy an asset. I've got to be frank with you. I don't think values are going to take off, but we don't need that in order to restore the business to health and to be in a position where we're investable. And I think we've reached that position. And I think it's a great testament to everyone that we've been able to move leverage from 70 to 49 in one step in the way that we have. So I think we feel very good about the future. Our focus immediately now is on improving operational performance and getting back to paying a dividend. That's the objective.
Brilliant. Thank you so much to all the participants for joining, and thank you, Lawrence and Stuart, for the presentation.
Thank you, everyone. Thanks for joining. Thank you.
Ciao.